Hello guys, welcome back. So in this video we are going to talk about a company that I haven't actually made a video about before, which is a little bit surprising because I have made all sorts of videos about all sorts of companies and somehow I haven't touched VMware, a very well known one. And it's time. This company has been down 23% from its 1 year high, recently going much higher. You will see that the company was sitting at $95 just a few days ago, and right now it's going higher to 130. Now it may make sense to take a little bit of a closer look and see whether it's actually a good buy here. We can first examine the stock news, the current stock news, and you may have heard about this one. Broadcom is buying VMware for 61 billion. That was one of the stories that happened like last week or so, and you will notice that Broadcom has offered 61 billion to buy cloud computing and virtualization company VMware, and this is a big part of why the company's price is higher, of course, as you can understand, because the deal would see shareholders receiving cash consideration of 142.50 per share, which of course would probably mean that VMware may go up a little bit till it reaches near this price. Of course, there is always a little bit of a risk of the deal not going through, but overall people keep buying this one until it reaches near this price. This is what typically happens with these kinds of acquisitions. And typically when an acquisition is announced, the company that acquires the other company tends to go down in terms of its stock price, at least for a little while. Now, let's go back to our stock analysis chart here and see what we can discover from this company. And you will see that the P/E ratio is actually 33% here, which is relatively high, of course. Now, this alone doesn't mean that the company is not a buy, especially when the price to free cash flow ratio is sitting at 13.7. Pretty important discrepancy here, which we need to examine. Outstanding shares that are going down as well, so the company buying actually issuing a little bit of extra shares here, not too much, 3.5%. That's not too much. I'm not really too worried about this one. But the company does have a little bit of extra total liabilities, it looks like, compared to the free cash flow. About 7.4 years would be required to pay all the total liabilities using last year's free cash flow. So that's something worth considering. It may be a little bit of extra debt. And the revenue keeps increasing nicely for this company. Remember, this is a huge company, although it's not making tons of revenue. But it is a company that is a very well-known one in the space and currently sitting at 54 billion for a market cap. So it is a company that has potentially a lot of growth to do in the future. Now, net income growth that keeps increasing, free cash flow growth is increasing as well, and it's only total equity that is going down, and quite a lot here. So we're looking at the equity of VMware going down tremendously here, and we need to examine why this is happening. Now, a very interestingly low price to sales ratio here, and the company is actually paying a dividend yield that you will see that it's mentioned as a 21% here, and a massive payout ratio. But let's take a little bit of a closer look at the dividends here, because these are special dividends that the company is announcing here and there. Last one was like 3 years ago, and so it's like a one-off payment here that wouldn't put significant burden in the company's operations, as you can understand. This, I believe, had to do with the Dell spin-off, so probably you won't be seeing this kind of special dividends anytime soon, but you shouldn't be too worried about them. Pretty much consider this as a company that's not paying any dividends. And let's take a closer look at what the company is doing in terms of its financials, of course. You will see 7.9 billion in revenue to 12.8. That's okay growth. It's not bad at all. But it's not explosive, as you can understand. It's still pretty good growth, though. And net income from 570 million to 1.8 billion. This is pretty good actually for the net income. It actually increases faster than what the company is doing in revenues, and that is actually very good and very nice to see for a company pretty much increasing their margins here. Now, take a look at the balance sheet here, which is very interesting. You will quickly notice, if you take a look at that, the current assets of the company have been going down a little bit, like their cash and cash equivalents have been kind of going down here. And you will also see, if you scroll down a little bit, that the company has been getting more in current liabilities as well, meaning that they are getting some extra debt. Actually, apologies, the non-current liabilities, long-term debt here. You will see that last year, 2 years ago, they got 5.8 and now they got 13.6. That is fiscal year 2022, pretty much as reported. And you will see that from 11.5 billion, the company went to 20 billion of non-current liabilities here, pretty much adding a lot of extra burden to their total liabilities here, about 10 billion. And this is why this number has increased a lot, and right now it has surpassed the total assets. It looks like the company is getting quite some extra liabilities here. Now their total liabilities are sitting at 330 billion here, and if we take a look at the cash flow statement right quickly here, you will see that they are making 3.9. And if you do the division, is what we saw earlier. It's about 7 years, 7 point something, I believe, of free cash flow to pay back all the total liabilities that the company has, 7.4. And that starts to become a little bit much. I'd like them to alleviate a little bit of that pressure, but it's probably not super worrisome. It looks like the company can sustain that. Although, yeah, I would definitely like them to cut down on this extra debt potentially, but you can use this debt for leverage as well. You can use it to make more money if you use it the appropriate way. So right now the company's extra debt doesn't really concern me much, but it's something to keep in mind. And you will notice that the company's operating activities cash flow is increasing a lot from its net income, because stock-based compensation and depreciation and amortization is added back, and that's quite heavy on this company, which is obviously expenses deducted from the net income. They need to be added back here to our operating activities cash flow, because they are not cash expenses. Now the company is also spending just a little bit here in investing activities. It's mostly capital expenditures. And over here you will see what is happening with the company's cash by financing activities. A lot of extra dividends paid here, 11 billion. That was of course the one-off thing, which was also paid 3 years ago, as you will see. The previous years they haven't been paying any dividends here, as you can understand. And as we already saw pretty much. And the company has less cash, as what we examined also earlier, than what they used to have. Now, it looks like an interesting company. It looks like they got a little bit of debt. That can be okay. But what is about the price of the stock? Is it a good price to buy right now? Because this is a company that definitely has some risk, and we want to be making sure that we are buying at a fairly good price here if we're about to buy this one. And you will notice that in the last couple of years they had almost 9% revenue growth. So I'm gonna go with something like 6, 7, and 8 here. And net income margin, as you will see again over here, it's been a little bit all over the place, and it's kind of going down, it looks like, in the past years, like 2021 fiscal year and 2022. I think I'm going to go with something in between, maybe. So 15, 16, and 17, and see what we get out of these ones. Whoops, 17 over here. And free cash flow margins, again, a little bit all over the place here. And that's mainly because their net income has been also all over the place. So we will go with something that is rather typical, 80, 90, and 100, and an annual return of 13%. So if we hit calculate here, you will notice that the current price of the company is a little bit elevated compared to what we'd like to get it at. Now, yes, I didn't go overboard here. This may be actually conservative estimates. Let's just try to go a little bit higher and just say that the company will continue having the net income margins that they had, actually will go back and have a little bit better margins that they had in the previous years. So this actually, compared to the last couple of years, is normal. But let's just say that they achieve 18, 19, and 20. We are a little bit more confident, and that the revenue keeps increasing a little bit more than what we anticipate, like maybe let's go 9, 10, and 11 here. See what we're getting out of this one. This is interesting to at least examine. And in this case, it's only the high estimates that give us a current price which is acceptable, and it's actually almost exact to almost like 9 cents or so. And so with these kinds of projections, 11% revenue growth, which could happen, net income margin of 20%, which is a little bit elevated here, and this can happen easily as well. It is only then when we are getting a high estimate that is actually a green line for purchasing the stock. So as it is right now, it's expensive, and if we actually bought that when it was down at some point, if we take a look at the previous month or so, maybe 3 months, at some point, yeah, over here it was like 93. This was a much better price, and over there I think the company could have been an interesting addition to a portfolio maybe, but right now 130, and actually today 126 it looks like, still a little bit expensive, a little bit more expensive than what I would like to get it at. Thank you for watching the video, guys. I hope you liked this one. Please remember to leave a like and subscribe. And if you are interested in getting access to this tool, remember that you can find links in the description box below on how to access it and how to become a Patreon. And also, you can also find the link to access our Discord channel. So come chat with us. We are pretty much chatting every day. Very, very nice discussions about all sorts of things, stock market and investing. Thanks for watching. See you soon. Bye-bye.